Welcome back to It's the Economy. Tariffs seem to have begun to hurt the US economy. I'm referring to the latest data. In the overnight JOLTS data, job openings for March missed estimates. Consumer confidence for April has dropped to the lowest level since the pandemic. But GDP numbers will be due. A lot of numbers are due today. How will growth be impacted in the US itself and globally, in Asia in particular? Today on It's the Economy, I have with me a veteran from JPMorgan, Luis Oganes, head of global macro research. He manages teams of researchers covering currency, rates, commodities and emerging markets. Thank you very much, Luis, for joining us. Well, as of now, including the 10% across-the-board tariffs and the 25% auto and steel, the US tariffs are averaging 25%. Versus only 2.5% before April 2nd. What will this do to US growth itself, and will it mean stagflation?
I think that, beyond the level at this stage, honestly, is not known. We have a situation where a big chunk of the tariffs have been reduced to 10% for 90 days. That 90 days are going to be completed sometime in early July. And it's an open question what comes afterwards. There is obviously some discussions with individual countries. India is actually included in there about reaching some kind of trade agreement that would potentially reduce on a permanent basis some of these tariffs. But we don't know. So quantifying that, I think, is still very, very difficult. What we do know is that all these backs and forths are generating a lot of uncertainty for those that need to make decisions in the real economy, decisions about investment, decisions about hiring, decisions about how much to produce. And we think that that uncertainty is probably going to lead to some cool down in growth. Whether we get to a recession or not, to be honest, at this stage, it's almost like a semantic discussion. The starting point is a good one, which is so far the data flow in the US is actually quite resilient, quite good. But, we could have a deceleration that stays just above zero or drops below zero, in which case it is a recession. But I think that you're going to start to see indicators of growth in the US weakening, indicators of inflation accelerating, and that's going to be a very complicated macro picture for the US, regardless at this stage of what happens at the end of the day with tariffs.
Okay, so uncertainty to kill growth. What about global slowdown? And which parts of the globe or the world will be more impacted than others?
Well, strictly speaking, to the extent that there's an element of self-inflicted wound, it is possible that the US falls into a sharp slowdown / recession, and maybe the rest of the world per se, on average, doesn't. That said, there's going to be a wide variation, dispersion of country experiences. Certainly those that are more integrated trade-wise with the US, starting with its neighbors, Mexico and Canada. Probably those two economies are already in recession or will fall into a recession in the coming months, in the coming quarters. Just because right now, everyone is holding their breath. We don't know the outcome of the renegotiation of USMCA that is going to happen potentially in the second half of this year. But then when we start to go around the world, you have countries like Vietnam, like Cambodia, quite integrated, sharing a lot of the exports going to the US, that even though the tariffs right now are 10%, we don't know, and these countries don't know, producers in these countries do not know what will happen at the end of this 90-day reprieve. So I think that is probably going to lead to lower growth, regardless, again, of what the outcome is. Other countries, obviously, may eventually benefit. But I think that right this minute, you're going to see a global growth slowdown pretty much happening everywhere, some places more accelerated than others. And it's only clarity that is going to lead eventually, hopefully soon, to some reprieve and some rebound. For the time being, we're all holding our breaths here.
Okay, yes, more integrated countries, more impact, and of course the neighbors already in recession. Now, what about inflation? Economists are telling us that there will be disinflation in Asia because, exports that don't go to the US will find a market here. Manufacturers are telling us that they're already seeing higher steel prices, for instance, because of anti-dumping duties and possible supply chain issues. What's your guess on whether here in Asia we are going to have more disinflation or inflation?
Well, I would say again, different experiences. In the US, we think that inflation is going to be higher for the mere fact that imports are going to be more expensive. And they're not, the path to replace imports, particularly those coming from China, takes a while, right? To reorient your supply chains, to look for alternative sources of supply, production, of imports of consumer goods. That will take quite a while. In the meantime, we're going to have inflation pressures. Again, the magnitude is very difficult to estimate. With the latest postponement until for 90 days of some of the harshest numbers of tariff increases, our economies are penciling in inflation, maybe staying inside 4%, maybe 3.8% by the end of the year in the US. In the rest of the world, we're going to see a mixed bag. Certainly, less growth in the US, less growth around the world means there's deflationary pressures coming just from weaker demand. But as you well say, there is a lot of fear that China, whatever they cannot sell to the US, they're going to turn around and try to sell it somewhere else, and they're going to flood the rest of the world with cheap exports, which is deflationary for many of these countries. That's one thing. The other one, and some countries may be forced just to protect their domestic industry to actually increase restrictions, tariffs themselves on Chinese imports from China. So again, very difficult, depends on the policy response to assess what the impact on inflation is. The one thing that is going to help at least the energy importing countries, oil importing countries, is the fact that oil prices have declined, right? India is certainly in that camp. And so long as authorities allow some of the pass-through from lower international oil prices to fall through domestic fuel prices, maybe that turns into a little bit of a offsetting factor for inflation when it comes to compare to whatever response there is on the tariff side.
Oh, yes. Crude will be a major offset for India. I'll come back to crude in detail, but first let me finish currencies. The dollar index has already fallen below 100, staying there. Do you expect dollar to weaken more? And what about Asian currencies?
So, in a way, for quite some time, we have had this narrative in markets and in the global economy of US exceptionalism, in which the US was the economy that was growing at the fastest pace within the developed world. It actually had interest rates, both in nominal and real terms, being among the highest across developed countries. Of course, the equity market was on a very strong upward trend. So there was nothing to dislike, right? And investors, I would say, globally were quote unquote overweight US assets, overweight dollar-denominated assets. Many of these pillars are changing, right? We're discussing now doubts whether the US economy could actually fall into a recession. We are talking about the equity market being a lot more volatile. Interest rates, the Fed at some point is going to start cutting rates. The acceleration of inflation is going to be eroding the so-called real interest rate. So the dollar, I think, probably has more to weaken here. We're not necessarily in the camp of those calling, this is a mega de-dollarization trend, and that it's the end of the story for the dollar, for the mere fact that there's actually no other currency really to replace it. There's no other bond market like the US Treasury market that is as large and as liquid to take it over. So I think that this de-dollarization probably and this reduction in dollar exposure by the investors around the world will continue, but it's going to have a limit. But in that continuation that we're talking about here, in moving, let's say, from overweight to neutral, the dollar, probably the dollar has more weakness to experience. We have, for example, a forecast for euro dollar going to maybe 120, 122 by the end of the year. We had a forecast that was already out of consensus of 114, 116, and literally we saw that being hit last week already, right? And we're still in April. So I think that probably for the time being we see weakness for the dollar.
Okay, so euro strength and more dollar weakness. Well, let me come back to the commodity. There are two key commodities that are important for India, also for the world. First, gold. And actually, today is a festival called Akshaya Tritiya when Indians buy gold. So what are your gold targets for the year? Also, what are your crude targets for 2025?
So for crude, we had a situation where oil markets were relatively, let's say, balanced, meaning supply and demand were at equilibrium up until last year. And this was because there was more production coming from the supply from non-OPEC producers, be it the US shale oil production, reaching historical highs under the Biden administration. You had producers like Brazil, Suriname, Guyana, Senegal, that were increasing production, forcing OPEC plus countries to actually reduce production in order to preserve some kind of price floor and some stability, with mixed results. Now, and the demand side was okay. Now we're talking about all this trade war leading to potentially a US slowdown, recession that could turn into a global slowdown slash recession, in which case demand for energy, of course, will go down. And curiously enough, OPEC plus countries on the same day that the US announced its tariffs, the so-called Liberation Day, April 2nd, they actually announced that they were going to be increasing production. Right, so it looks like they are now in the camp of looking to regain the market share that they lost. So we're looking at basically an oversupplied oil market where we're expecting oil prices to potentially continue to go down. So last year, Brent was in the mid-70s on average. This year, we're expecting it to be in the mid-60s. And by the end of the year, going into 2026, potentially fall into the high 50s. So the direction of travel is, we think, it's an oversupply market that is going to lead to lower prices. Obviously, that is bad news for exporters, but good news for importers, and India counts itself among them. In the case of gold, that has become the ultimate safe haven amid all the uncertainty that we're discussing here, right? We had seen that it took around 12 years for gold prices to increase from $1,000 to $2,000 per ounce troy. It took 4 years to go from 2,000 to 3,000. And it may well take less than 1 year to go from 3,000 to 4,000. We're halfway through it. Can we see 4,000 later this year? Absolutely, unless magically happens that reduces all these global geopolitical risks that we're discussing here.
Okay, $4,000 on gold. You're giving us a very big number on a day when people will be lining up to buy gold. Thank you very much, Luis Oganes, for giving us a 360-degree perspective on commodities, currencies, and growth. Thank you very much. We have to wrap up Bazaar on that note. Chartbusters coming up after the break.